The moment you turn 60 in Australia, your superannuation becomes a completely different financial instrument. The rules change. The tax treatment changes. The strategies available to you change. And most Australians over 60 are still managing their super as if they were 45, missing opportunities worth tens of thousands of dollars that the system makes available specifically because of their age. This isn't about complicated financial engineering. These are strategies written into the legislation. They exist because the system was designed to support Australians in the decade before and so after retirement. But they only work for you if you know about them. Today we are covering the hidden super strategies that Australians over 60 should be using right now and almost certainly aren't. By the end of this video, you'll know exactly which ones apply to your situation and what to do with each of them. Let's start with the one that changes everything, and it's the one most people understand least clearly. After your 60th birthday, every dollar you withdraw from your superannuation is completely tax-free, not reduced tax, not a concessional rate, zero tax, on every dollar that comes out of your super fund. This sounds straightforward, but the implications are far more significant than most people realize. Before 60, if you needed to access your super under specific conditions, the taxable component of your balance attracted tax at varying rates. After 60, that changes entirely, and this tax-free status applies whether you take a lump sum withdrawal, move to an account-based pension, or draw income payments. All of it completely tax-free. What does this mean in practice? If you are still working in your 60s and earning income, the tax-free nature of your super withdrawals means you can blend super income with employment income in a way that is dramatically more tax-efficient than relying solely on your salary. Your super income doesn't need to be declared as assessable income, which affects everything from your marginal tax rate to your Medicare levy to your offset eligibility. And if you are no longer working, if you've retired, then every dollar you draw from your super to fund your lifestyle costs you nothing extra in tax. The money that went in, taxed at 15% on the way in, comes out entirely tax-free. This is the deal that the superannuation system offers Australians over 60, and it is genuinely one of the most favorable tax structures available anywhere in the developed world. But here's where most people over 60 leave significant money on the table, and it connects directly to the tax-free withdrawal concept. If your super is still sitting in accumulation phase after 60, you'll break super in 15% tax on your investment earnings every year, when you don't have to. Moving your super from accumulation phase into pension phase, specifically into an account-based pension, means those same earnings are taxed at 0, not 15%. 0. This is not a complicated process. It's an administrative decision made with your super fund. You move your balance, or a portion of it, into an account-based pension. The fund adjusts the tax treatment on your earnings accordingly, and from that point forward, your super earnings are protected from tax entirely. The impact over time is significant. On a balance of $300,000 earning 7%, that's $21,000 in annual earnings. At 15%, you're paying $3,150 in tax on those earnings every year. Move to pension phase, 0. That $3,000 stays in your fund, compounding forward every year. Over 10 years, with compounding, that difference isn't $30,000. It's considerably more, because each year's saved tax also earns returns. Most Australians over 60 who are still in accumulation phase are in it by default, not by choice. They never made an active decision to stay there. It was simply never pointed out to them that they could, and should, review this. Now here's what surprises people who are still working past 60. This strategy is specifically for you. A transition to retirement income stream, what financial planners call a TRIS, allows you to begin drawing a pension income from your super while you are still working. You don't need to retire. You don't need to reduce your hours. You simply need to have reached your preservation age, which for most Australians is 60, and be connected with your super fund. Here's how the strategy creates real financial benefit. You salary sacrifice a portion of your pre-tax salary into your super, reducing your taxable income and therefore your income tax. At the same time, you draw a pension income from your TRIS to replace the take-home pay you've directed into super. The pension income after 60 is completely tax-free. The salary sacrifice contributions enter super at 15% tax instead of your marginal rate, which for many working Australians in their 60s is 32%, or we're higher. The net result is that your take-home pay stays roughly the same, but a significantly larger portion of your money is flowing through super at a lower effective tax rate. You're not reducing your standard of living. You're restructuring where your money goes and the tax treatment of every dollar. This strategy requires coordination between your super fund, your employer's payroll department, and your accountant. It's not something you set up in 5 minutes. But for working Australians over 60 who are in a higher marginal tax bracket, the annual saving can be measured in thousands of dollars. The next strategy is one that most people assume doesn't fulfill, and that assumption costs them real money. Spouse contributions. If you are over 60 and your spouse is under a certain age threshold, making a personal super contribution on their behalf may entitle you to a tax offset. The government's spouse contribution tax offset is designed to encourage couples to grow the lower earning partner's super balance, and it provides a direct reduction in your tax bill in the year the contribution is made. The eligibility conditions include income thresholds for the receiving spouse, and these figures change, so always check the current ATO criteria. But the principle is consistent. If your spouse earns below the relevant threshold and you contribute to their super, you receive a meaningful tax offset on your own return. Beyond the tax offset, there is also a longer-term strategic reason to build the lower-earning partner's super balance. When both partners have super balances, the couple has more flexibility in retirement income planning, more options around which balance to draw from first, more capacity to manage assets, test positions relative to the age pension, and more opportunity to use both partners' tax-free income streams efficiently. Many couples in their 60s have significantly unequal super balances because one partner took time out of the workforce to raise children or worked part-time for extended periods. Spouse contributions, made consistently in the years leading to retirement, can meaningfully address that imbalance and improve the couple's overall retirement position. Let's talk about the investment option review, because this one is quiet, invisible, and consistently one of the most impactful decisions an Australian over 60 can make. Your super fund has multiple investment options: a default balanced option, growth options, conservative options. Each of these has a different mix of assets: shares, property, fixed interest, cash, and each carries a different level of volatility and a different long-term return profile. Most Australians choose an investment option once, usually by default when they first join their fund, and never change it. Decades later, they're still in the same option, regardless of how their situation has changed. Here's why this matters, specifically after 60. Someone who is 62 and planning to retire at 67 has a very different investment time horizon than someone who is 35. 5 years to retirement means the investment strategy needs to account for sequencing risk, the danger that poor returns in the early years of retirement can do lasting damage to a balance that is now being drawn down, not just accumulated. A high-growth option that was appropriate at 40 may expose a 62-year-old to unnecessary volatility at exactly the wrong time. But a very conservative option may mean the balance doesn't grow enough to meet retirement income needs over a 20-plus year retirement. The answer isn't a formula. It's a review. Sit with your super fund's information or your financial advisor and genuinely assess, does my current investment option match where I am and where I'm going? Has anything changed in the past few years that makes a different allocation more appropriate? If you haven't done this review in the last 2 to 3 years, doing it now, before you agree within 3 years of retirement, gives you time to course correct if needed. Here's a strategy that many people over 60 overlook simply because they never thought to ask. Beneficiary nominations. Your super does not automatically form part of your estate. It's held in trust by your fund, and it's distributed according to your nominations, or, if you have no valid nomination, at the discretion of the fund trustee. If you made a binding death benefit nomination years ago and never updated it, that nomination may have lapsed. Most binding nominations expire every 3 years, unless your fund offers non-lapsing ones. If your circumstances have changed, divorce, remarriage, children who are now adults, a new partner, an outdated nomination may direct your super to someone other than the person you rides. And as we've covered in an earlier video, Adult children who are financially independent will pay up to 17% tax on the taxable component of your super they receive. A spouse who is a dependent receives it tax-free. Checking your nomination takes 5 minutes on your Superfunds portal. Updating it takes another 5. For something that could redirect tens of thousands of dollars or create a tax bill your family never expected, this is one of the most high-value 15-minute tasks available to any Australian over 60. Let's look at what all of these strategies look like when they've stayed reapplied together through one person's situation. Consider a man. We'll call him Ray. He's 63. He's still working full-time as a project manager. His wife is 59 and works part-time. They have a combined super balance split unevenly. Ray's is significantly larger. He's in the default balanced option and hasn't reviewed it since joining his current fund 7 years ago. His binding nomination names his adult children directly. He's never set up a transition to retirement pension. His super is still in accumulation phase. Ray discovers these strategies through a conversation with a financial advisor he finally decides to see. First change, he moves a portion of his super into an account-based pension, switching his earnings from a 15% tax environment to 0. The annual saving on his balance is meaningful immediately. Second change, he sets up a tris with the remainder of his accumulation balance, coordinating it with salary sacrifice through his employer. His take-home pay stays the same, but his effective tax rate on the sacrificed portion drops significantly. Third change, he makes a spouse contribution to his wife's super. She falls below the income threshold and receives a tax offset on his return. Fourth change, he reviews his investment options with his advisor, moving to an allocation that's more appropriate for his 5-year timeline to retirement, while maintaining enough growth exposure for a long retirement ahead. Fifth change, he updates his binding death benefit nomination, directing his super to his wife as a dependent rather than directly to his adult children, eliminating the 17% tax his children would have paid under the previous nomination. Ray makes 5 changes in a single financial planning session. None of them required unusual complexity. Each of them was available to him for years. The combination creates a meaningfully different retirement outcome: lower tax, better growth alignment, protected inheritance, and a superstructure that works actively for him, rather than simply running on autopilot. Here is what you should do now, in the order that creates the most impact. First, if you are over 60 and your super is still in accumulation phase, contact your super fund this week and ask about moving to an account-based pension. Ask specifically about the tax treatment of your earnings in accumulation versus pension phase and what the process is to make the move. Second, if you are still working, ask your super fund whether they offer a transition to retirement income stream. Then speak to your accountant about whether the tris and salary sacrifice combination creates a tax advantage for your specific income level. Third, if you are part of a couple with unequal super balances, check the current ATO eligibility criteria for the spouse contribution tax offset. If your spouse's income falls within the eligible range, a contribution before June 30 delivers both a super boost for them and a tax offset for you. Fourth, log into your super fund portal and find your current investment option. Ask yourself honestly, was this option chosen deliberately for where I am now, or is it the default I've been in since I joined? If it's the latter, a review is overdue. Fifth, check your binding death benefit nomination. Is it current? Is the named beneficiary still the person you intend? Does the nomination reflect your current family and financial circumstances? If anything has changed, update it. After 60, your super is no longer just a savings account waiting for retirement. It's an active retirement tool with specific strategies, specific tax advantages, and specific rules that create real financial opportunities, if you know how to use them. The 5 strategies covered today: tax-free withdrawals and pension phase transition, the tris for working Australians, spouse contributions, investment option review, and beneficiary nominations, are all available to you right now. They don't require unusual income, unusual circumstances, or complex restructuring. They require knowing they exist. And now you do. If any part of today's video raised a question about your own situation, your accumulation versus pension phase status, your beneficiary nomination, your investment option, write it in the comments below. I read every one of them. And if you want a full video dedicated to any single strategy here, Just let me know which one. Your retirement deserves a compass, not guesswork.